Review for January 3rd, 2025. We started with a gap up, but we gapped basically into the middle of the prior day's range. And the prior day was an outside bar. And when you have, or an outside day, an outside bar on the daily chart, when the prior day is an outside bar and you open essentially near the midpoint of that daily range the following day, there's an increased chance the following day is an inside day. So there was an increased chance coming into the day with this open that it was somewhat of or that it ended up being an inside day. Obviously, that was not the case today, but it was possible that that ended up happening. And inside bars are obviously high ones on higher time frames. So if you did get an inside bar, it would be just a high one essentially on a higher time frame. But we get a gap up for the bulls and a bull bar with a large tail on the top and a tail on the bottom. Probably buyers not too far below, probably sellers not too far above. The prior day's context is important here. You can see we're essentially in this area, and bar 2 is a breakout above the high of this range over here. You can see this high, this high, this high. So a spike down and then a trading range and then another sell-off, and we're essentially trying to break out of the high of that trading range on bar 2. It's a good bar for the bulls, but probably going to pull back soon. This looks more like a trading range open. It's possible. Let me just clear this up. It's possible that we go up on leg 1 and then we pull back on leg 1, as you can see. Then we go up again on leg 2, and 2 ends up becoming some sort of nested second leg trap. Bar 3 is a doji bar, so probably traders willing to buy below 3. Where do you buy, right? That's kind of a good question. Do you buy the high of 2 or do you buy below 3? Because this is a breakout gap, right? Right here. 1 and 2 is a breakout, with 3, this is a gap with the 1 high and the 3 low. So the bulls are going to try and keep that gap open if this is a bull trend, but it's probably a bit more of a trading range, if anything. Hold on a second. My mouse is freezing. All right, I believe it should be back. So you can see bar 4, we sold off, and bulls didn't really end up buying this high. Now, what's the problem, right? The obvious issue with this trade is that you can't really put a stop below 1. You know that 1 and 2 is going to get a second leg, but if this is trading range price action and after 4, this is a trading range, right? It's pretty obvious that this is a trading range. So it's more likely that there are traders buying below 1 and 2 than there are traders selling. So if you bought the 3 low or you bought the 1 high or whatever it is, you really can't have a stop down here. It's okay to get out below 4, I think, but it's really difficult to just put a stop down here and let yourself get stopped out because big up, big down, big confusion. If you were long or if you weren't long and you wanted to get long, something you could do in this big up, big down situation whenever you get that is you could put an order to buy at the low of bar 1. Where would your stop be? Your stop would be a measured move down. So you have 1 and 2. So this is a situation in general for big up, big down. Or when you think the market's in a trading range and you don't want to get trapped buying high and you think that the breakout below is going to fail. So you could buy the bar 1 low during bar 5. And basically, if you're doing that, you're taking a chance that bar 5 does not close on its low. So you have to have a good calibrated expectation. Otherwise, you can get trapped in a bear trend. So if you're buying this low, you're expecting that bar 5 does not become a big bear bar closing on its low somewhere down here. Because if that's what happens, then it's possible we're turning this into a bear trend. But you're basically expecting bar 5 to close above its midpoint and the next bar to be a bull bar. And that's what you get. So if you're buying this low, 5 can't close on its low, and it doesn't. And that's the whole thing of day trading. It's not, no one knows what the next bar is going to look like, right? So like if I buy this low 1 minute into bar 5, I have no idea what bar 5 is going to end up looking like, but I understand what the possibilities are, and I understand what the possibilities mean depending which one shows up. So when I buy the 1 low during 5, I don't actually know what 5 is going to look like, but I know what, I've seen it hundreds of times before. So I know what it can look like and what that, has a probability of leading to. 6, an inside bar. It's a double bottom, 1-6, a lower low double bottom. We're probably going to be a little bit more sideways here. I'd imagine there are probably sellers somewhere above 6, scaling in higher after 3, 4, 5. So kind of similar thing. You want to sell in the sell zone, so the upper third of 3 through 5. This 1 and 2 is going to get a second leg, and it could be starting now. 7, a big bull bar, good for the bulls, probably going, a little bit higher, but we could pull back first. Again, big up, big down, big up. So this is 2 legs up, right? Well, we might get a third leg up, but It is a trading range, so 2 legs up, and we got 2 legs down as well. It's a weak bear channel, so there are probably traders willing to buy somewhere below. So 8, the doji bar. If you bought above 7, what are you hoping for if you're buying above 7? Well, you're basically hoping that this is a bull trend. Now we're going to get at least one tick above here, and we're going to get a good looking follow-through bar on 8. It's been 2 bull bars and then a failure, 2 bear bars and then a failure. So 2 bull bars might be a failure on 8. And then you can see the bulls who bought above 7, disappointed 8, just used the tail on 9 to sell out of their longs. They're not really willing to hold. You could, if you're aggressive, you could sell. Basically as 9 was rallying, you could sell in this area because it's around the area where the bulls who bought the close of 7 or bought above 7 are disappointed in 8. And so you could bet that they're going to exit because it should be a trading range. And now we're going to fall back down into this area. That would be a logical thing to do. And you can see we sell off a bunch on 9. Probably traders buying somewhere below, probably. But if we rally again, probably traders selling somewhere above. 10, a bear bar. Good for the bears, but a large tail on either side. It's 3 straight bear bars. The bears are going to need a good looking bear bar closing below the moving average in order to convince anyone of anything. And then we get a reversal up on 11. Disappointing for the bears. It's 3 legs down, 1, 5, 11. So probably traders, probably at least 2 legs sideways up. You could buy above 11. Not really ideal though. I didn't mark anything in the opening 18 bars because the reality is, yes, there are reasonable trades in here, but they're not really that great. Nothing in here was really all that great. So 11, a reversal up, yes, a wedge bottom. 12, follow through for the bulls. 11 and 12, good for the bulls. Probably going to get a second leg up. You can see buyers below 12. That was probably one of the better limit orders on the day, buying the 12 low, because that we're going to end up getting at least a second leg up. So you buy the 12 low, outside up bar on 13. You buy above 13. I don't know. It's worse to take stop orders because now you're in the middle of the trading range. Buying the 12 low was in the lower part of the range. And now if you're buying the close of 13, you're buying like basically the middle of the trading range. So it's not as good. Doji bar on 14. And why is there a doji bar? Because a lot of the bulls are just scalping out. They bought the 12 low. And as 14 was rallying, they got 10 points, whatever it is they wanted, right? 10 points is a logical target. Some of them even got 15. So 10 to 15 points and scalp. 15, a bull bar. Again, 14 was the minimum follow through for 13. So really not that great. 15, a bull bar, but a large tail. An inside bar on 16, but a doji, not really that great. Buyers below 16 during 17. Probably one more leg up, 1, pull back 2, pull back, and then 3. 18, a bull bar, but a large tail. Probably going at least a little bit higher, but I'm not sure how much higher. And then 19, another bull bar, but closing 1 tick above the 3 high, a breakout. But 18 and 19 is not a great breakout. I think that it's rather poor. You need a good-looking bull bar. Does 18 and 19 look like a new breakout, or does it look like a leg 3? It probably looks a little bit more like a leg 3. A breakout should look like this. Look at 24 and 25. It shouldn't look like 18 and 19. It can look like 18 and 19, but if this breakout is going to work, you're going to get a couple more bull bars, and you're going to start to channel higher. So it's really not that great. And then a big bear bar 20. This is kind of the last chance for the bears because we have had all bars below the moving average or above the moving average so far today, and it's been a trading range, right? So if you're in a trading range, you can check who's winning the moving average battle, and the bulls are clearly winning it. We haven't gone below it yet today. So 21, the doji bar, probably. I think it's disappointing for the bears who sold below 20, taking a chance that we basically collapse. If you're selling below 20, you're hoping 21 is an equal size bear bar to 20, and you're basically hoping that we collapse below the moving average and start a big move down. Instead, you get disappointment on 21. 22, consecutive bear bars or consecutive bull bars, and a bull bar closing somewhat near its high. I think bears have to get out above 22, and you can buy the close of 22, taking a chance that we get at least 1 tick above the 19 high, and that this is a bit more bullish. 23, another bull bar, a large tail on the top, and then 24, a 4-bar micro channel. You know what I'm going to do? I'm going to buy the close of 24. I'm going to go for a measured move somewhere up here. 25 consecutive bull bars, good for the bulls. So we're going higher. Again, 4-bar micro channel, high probability, 80% chance of a pullback, 80% chance we're going to get a second leg. Second leg should be somewhat similar size to the first leg. So even if we get a complex pullback, I'm still expecting more to the upside. 26, a doji bar, good for the bulls. We're probably going at least a little bit higher. Yesterday's high is right here, 59.85, and you can't ignore 6,000. I think we'll touch 6,000, presuming that Monday is no gap. I don't know if there's going to be a gap. If there is, I don't know what it's going to look like. But presuming Monday is somewhere around here on the open, we should get at least one tick above these 3 bars because they need a second leg. And I think we'll probably hit 6,000. 27, another bull bar. So 7 straight bull bars, obviously a bull micro channel, but it's getting, climactic. So there will be buyers below 29, but we might get somewhat of a complex pullback before that clear second leg. 28, another bull bar. 29, another bull bar. So doji's slowing up, right? Look at this breakout. Look at, this versus this, right? I'm going to do it this way. Look at the difference. This is strong, good bull bar closing your tie, good bull bar closing your tie. This is a follow through bar for the breakout, which is 22 essentially. And then dojis. So it's obviously the momentum is slowing. It's a spike in channel on a lower time frame. Spike and then channel. You should, I was going to make a video on it specifically, but I'll just mention it here quickly, and then I'll probably make a video at some point on it. But you don't use lower time frames to make decisions about the 5-minute chart. You use the lower time frames or to make decisions about how a bar formed. So if you saw 25, well, first off, if I see this 21, 22, 23, 24, I'm buying. I don't care what's going on any other time frame. But if you're in a spot where you're not sure about a trade, where you see a breakout 26, 27, you say, yeah, that might have been a good breakout, but I want to see how it looked on I want to see how it developed. How did it look? Then you can look at a lower time frame and see how the bar developed. So if you have a bar that was on its low for 5 minutes and then in the last minute ended up closing on a tie, that's not as strong as a bar that was closing on a tie the whole time. So that's where you can look at the lower time frames and say, yeah, this bar might not be as bullish as it appears, or things like that. But again, you only do that if you're unsure. When you see clear price action like this, there's no real reason. 30, buyers below 29, probably going to get a second leg up. 31, an inside bar, a bull bar closing on a tie, probably sellers above, scaling it higher. And you can see 32, we rallied to that high and got a second reversal down. 33, a bear bar. Am I selling this double top? No, you shouldn't sell it. It's a minor reversal. Especially, if you're still working on trading, don't trade minor reversals. Try to trade major reversals. So 33 consecutive bear bars, but again, it's minor. Better to be buying these closes than selling them. An outside down bar, 34, good for the bears, but they keep getting bars that have large tails, like 34, and there's a tail 33, 32. So bears aren't really getting any strong breakout bars, and they're not moving very far. Although 34 might look like a scary bar, it's not really closing that far below 33. It's not nearly as threatening as it might appear. 35, a bull bar closing near its high, so 31 and 35, both good reversals up. Good looking bars. It just means we're probably going higher. The strength of the bar does indicate if we might end up going higher, but doesn't necessarily indicate when. So although 31 is a good bar closing near its high, I don't want to buy a high one at the end of the bull spike. This is the end of the bull spike, a pullback, and then a bull bar closing near its high. I don't really want to buy this high one. I want to buy, if I'm buying this, I have to stop somewhere down here. So I want to wait till we have 2 or 3 legs down, and then I can buy as it's probably going to start to go up. 37, a bull bar closing near its high. It's 3 pushes down, 30, 30, 34, and 36. So 37, a bull bar closing near its high. You can buy above 37, still no closes below the moving average, but it's going to be a swing trade. 38, a doji, so not follow through. 39, initially sellers above 38, a high one, but probably going to get a second leg. Buyers below 39, and 40, a bull bar closing near its high. 41, 42, consecutive bull bars follow through. Traders buying below 42, or buying as we get close to the moving average for another leg up. 44, a bull bar, a large tail. And then 45, whenever you have a 9-bar bull spot, or your corrections are generally twice as long as the move. So you get a 9-bar move and then an 18-bar correction and then a breakout 40 to 8. So 21 to 30 or 21 to 29, essentially 9 bars and then 18 bars and then a breakout. 46, a bull bar closing on its high. I thought of this as the go bar. I've mentioned the concept of go bars before, but just for me, it's just whenever I look at it and say, if this is going to work, it's going to work now. I thought 46 was that bar. We might pull back a little bit, but ultimately I thought, it looks like a third leg up, but it's a good bull bar closing near its high, and the context is good for us to go higher. So I thought that if we were going to rally, we probably weren't going to pull back too much more first. And if this didn't work, I thought we would pull back quite a bit before we got another attempt up. 47, a doji bar. So you don't really have to get out on the close of 47. I still think there's a chance we go higher. You really just didn't want 47 to close on its low. And then 48, a big big bull bar closing on its high, it's a buy climax, right? It's probably towards the end of the trend. However, it's a bull trend and we haven't been below the moving average yet today. So I still think it's okay to be long. Would I buy the close of 48? I don't know. You're going to get a second leg up from 48, but it's difficult to want to buy the close of 48 unless you have a stop down here and you're willing to buy more at the 48 low. So if you buy this close and you put a stop here and you're willing to buy more in this area, then you can buy the close of 48. 49, a disappointing bar, a large tail on the top and the bottom. Bulls are hoping we get a vacuum test of 6,000. It's not looking like we're going to get it. 50, a bull bar closing near its high. Good for the bulls. Again, this could be the vacuum test of 6,000, but disappointment. 51, 52 traded up to the 50 close. So bulls buy the close, disappointed 51 and exiting. They're hoping 52 was a big bull bar and maybe a third push up, but instead disappointment. Buyers below 52 during 53, and then 54. If you were watching it, there were sellers above. And it was a big disappointing bar, bulls giving up 54. So in my mind, when bulls gave up on 54, I thought, we probably would not test that much higher. Also, open gaps, the 19 high and the 37 low did not overlap. They just touched. So it was really difficult if you sold this high. You probably weren't really even able to get out. And then 54, as I mentioned, and then 55, a bull bar. You can see the same thing happened. We touched the 47 high. Or no, we did not. We missed it by a tick, 47 high and 54 low. So that's an open gap. And then a bull bar closing your tie 55, you can take the buy again, looking to get 6,000. 56, 57, 58, good for the bulls. You can buy. It's a 4-bar micro channel, but this particular setup that I mentioned all the time, I've found it to be very ineffective towards the end of bull trend days. So instead of buying here, I'm probably honestly, I'm pretty cautious and I'm looking to get out below a bear bar. I did buy. I'll mention my trades today. So I bought. I did really poorly just in the opening range, and then I made it all back. But I didn't make it back in a way that you should. So I bought the low of 3, and then I exited below 4. I bought the close of 9, basically taking a chance that we got another leg up before we went below 9. So I bought here and just exited there for a small loss. And then I just started doing really stupid stuff. I really shouldn't be taking any trades in here, so I'm just going to next week limit myself to 3 or 4 trades. Whenever the problem is there's too much time in the day. So whenever I trade through a practice day, I'm actually trading through practice days and I'm clicking through them, but I'm actually very profitable when I'm doing that. But when I sit there the whole day, a lot of times I get impatient. So I'm working on that. And I bought up here, exited down here, and then I sold here. And that was very not ideal. And I should have just exited on the close of 21. Instead, I waited till somewhere in here to exit. And then I bought the close of 24 with an Emini contract and put a stop below here and went for the measured move and got it. And that made up for everything I didn't hear since I was trading small over here. And then I traded large for the setup that I knew, which, I guess if you're going to do that, okay. But you really, trading small and losing a bunch of money and then trading really large for one setup is a recipe for disaster. And I've lived through that disaster plenty of times before. So I'm just next week not really going to try to limit myself to like 3 or 4 trades a day, because when I do that, I tend to do very well. I also bought 46 because I knew that this was, if we were going to rally, it would be now. And I exited over here. And then I bought 56 because consecutive bull bars, maybe we go to 6,000. And I just got out around break even below 59. I don't think 59 should really happen if we're going to go to 6,000. I thought it would just work. But I also knew once I saw the 4-bar micro channel that this is not a very reliable setup this time of the day. So I was ready to get out below anything. You could buy again above 60 if you wanted to, but you have to get out below 63. You can't just hold. This is not a reliable area to be long, and we should get to the moving average. So some traders will sell below 63. They might have sold below 59 as well. I don't think it's wrong to sell below 59. Just 63. A second reversal down is a little better. And 64, doji bar follow through. 65, a bear bar, a large pullback. 66, follow through. And then 67, a big bear bar. So 64 and 66 disappointing bars, doji bars. So 1, pause, 2, pause, 3, climactic 3 on 67, wedge. 68, an inside bar. 69, an inside bar. 70, an inside bar. So I pattern. Really, it's just sideways. And then after you get this sell off the moving average, nothing good is going to happen for the rest of the day. It's better to just be flat. As far as trades today, realistically, none of this is really great. If you traded in here and you look back through your trades at the end of the week, does any of this look like bars 1 through 20? Is any of this like the best area of the week to trade? Is it, is this a good area to trade, or is it probably the area where you should just leave it alone? if you look back at the, what's their 80 bars a day, so 400 bars a week. Is this in the top 20% of what you'd like to trade? Probably not. Right? Of the 400 bars, is it in within the best 100 bars to be traded? No, probably not. So that's I think it's better to just do nothing in here. Once you hit the 4 bar micro channel, 24, 25, these are by the close bars. You can hold through this or buy more for any reason. Basically, just betting that this reversal is going to be minor. And if you get a couple of strong bear bars and it's sort of an always in flip, essentially is what you're looking for in order to sell. But you're not. It's unlikely you get one. And obviously, what would quantify an always in flip? Consecutive bear bars below the moving average that look really strong, like a perfect bear bar. I'm trying to look for one. Maybe like if 67 closed lower somewhere down here, and you got that over here and multiple of them, then you could sell. You can buy above this. You can buy here. I don't know. It's hard to hold through all of this. It's difficult. And then I think you could sell 59 if you wanted to, or 63 if you wanted to. But those are difficult trades to take. Best limit order on the day, probably buy below 12. The daily chart. Might be forming some sort of triangle. I really don't know. I know that this is not strong for the Bears and it's not strong for the Bulls. So I think we're just in a trading range. So I'm not really worried about it. 3 good bull bars, good enough that this looks like a trading range pullback, not a trend pullback. 3 bear bars, 3 bull bars, and then we got 4 bear bars. And, it's an IOI pattern. Oh, wait, it's not quite an IOI pattern, but, do I think we're going to go buy a buyer's above here and we're going to race straight up? Probably not. Do I think this is going to fail in a spectacular way and race straight down? Probably not. We might get 1 pullback, 2, and then some sort of 2 or 3 bar pullback here, and then a third leg down and a wedge. That wouldn't surprise me. The weekly chart, you can see we're a little bit more sideways here. I wouldn't be opposed to if we get 3 pitches down, good looking wedge. Maybe I'll buy some calls or something. I don't know. But the monthly chart, well, you can see it's a new month. So we did trigger. Did we trigger it? Okay, we did not trigger below this low. I think it'll be important if we trigger below the December low, especially if we rally back up to like this high first, and the bulls who bought here are disappointed in this and they sell out and we get a big reversal down. That would be a credible short, but I don't know if that's going to happen. And then obviously I already mentioned the yearly chart the other day, so I won't go over it too much again, but I'd be interested to see what this year looks like. All right, that's going to be it for the day.